Hello, fellow investors, and welcome to another episode of Ritter On Real Estate, where we teach you how to passively invest like a pro. Today, my guest is Mark Khuri. Mark is the vice president and co-founder of SMK Capital Management. Mark's been in real estate for over 17 years. He's got a lot of experience and includes acquiring more than or valued assets of over $1 billion. So Mark has a ton of experience today. We're going to dig into some detail. We're going to learn from him and how he's looking at deals. So really excited for the episode in just today's market climate with all that's changing. But before we get there, Mark, thanks for being on the show. Let's start at the top and tell folks who you are and how you got to be where you are today.
Sure. Thanks for having me, Kent. Good to be here. So who am I? How we got here? Well, I'll try and keep it short, but I started in a career in finance in the early 2000s after graduating from school and worked in corporate America, gosh, all the way to 2010. Through that time, Kent, I started investing in real estate, on the side, very active investments, going to properties after work, fixing them up manually ourselves, hiring contractors, managing everything from A to Z. And did well, started partnering with family. So partnered with my brother, then we found another deal. We partnered with my folks, my other brother, just did that for about 6, 7 years before opening up our company. I was pretty much hooked by 2010. Decided to leave corporate America and partnered with my father, opened up our company, SMK Capital Management, really just at the time to expand our portfolio, to go out and raise additional capital outside of family money from friends and colleagues. And so we did that, and we essentially were an operating partner, sponsor for about 7 years, full-time, 2010, 2017. Through that period, we were really focused on heavy value adds. Kent, we were buying a lot of distressed assets direct from the bank, foreclosures, REOs, short sales, a lot of boarded up properties, single family, small multifamily, with partners, of course, passive LPs. And we've since divested of all that portfolio. We stopped buying those assets in 2017. Kent, it was a pivot, definitely a pivoting moment. And why'd we do that? Well, we saw kind of a little bit of the market changing. There was a lot less low-hanging fruit. Margins were getting squeezed. It was a lot harder to get the same or even less return than we were getting a few years prior. Markets changed. So that's essentially what we saw. Through that process, though, myself and my family were also investing as limited partners. I wanted diversification, so I started investing in mobile home parks and self-storage and larger multifamily, some student housing, senior housing. We actually invested in a little over 10 different asset classes within the real estate sector, with different operating partners. And we started comparing people. We started comparing risk and return. And by 2017, we had built up a pretty nice relationship base, I call it, folks, people that bring us deals, other operating partners, and decided at that point to just pivot and go full into private equity real estate, not as an operating partner, but more as a capital raiser, underwriter, and finding what we think are the best deals and allowing our investors to participate alongside us in them. So that's really where our focus is today.
Gotcha. Interesting. I mean, I like the evolution of the story. I definitely understand similar background in starting off with some of the more distressed stuff, the full-time job stuff, fixing, flipping, doing that. I did some of that early on, and similarly saw just the margins decrease over time. And so, yeah, similarly led me to other avenues and passive investing and focusing on larger multifamily, and different asset classes too. So definitely understand, that arc in the story. And then it's interesting. So you started as a sponsor yourself and then decided that you were going to focus more on the capital side. using your experience of operating for 7 or 8 years as a sponsor to vet deals. And that's really what you guys are focused on now is having an investor base and deploying capital with other sponsors, right?
That's right. Yeah, Kent. I mean, through that journey, I found myself and even my family members were constantly looking for diversification.
Mm-hmm.
And as a sponsor, you're usually only good at really good at one thing. And so it's hard to diversify, right? And so we took what we were doing personally with our capital, which was diversifying, and applied it to our business model a little bit more. We found that to be a really important pivot. It's benefited us and our investors greatly over the years, reducing risk and spreading out your capital across different regions, different operating partners, different asset classes, short-term, medium-term, long-term investments, income growth. We can really
Mm-hmm.
spread the gambit and achieve great results. So that's kind of why we did that. And today I'm just glad we did. We wouldn't probably be quite as spread out and diversified if we hadn't. That's for sure.
Yeah, very interesting story. And I like the evolution there over uh what about like a 20 year period, though, going from kind of the operating yourself to operating but with others, and then now really deploying capital. So got it, Mark. Well, I mean, I think you're the right guy to have this conversation with, sounds like. And so I'm excited to dig in today because I think with your background and all the deals that you've seen through your years of experience and interacting with all these different sponsors, I think you've got great context. And what I really want to dig into today is kind of zooming in on the last 18 months, right? And if we think about what the world looked like from a real estate perspective in first quarter of 2022, right, where deals in most asset classes were at all-time highs. And then you fast forward 18 months to where we are now, and the world looks a whole heck of a lot different, and deals look a whole heck of a lot different. And so I want to dig into that today, and we'll get into some of the specifics on how you're looking at deals. But to just start off, help us understand, like, when I say the world looks totally different, what does that mean to you? What are some of those key things that have changed in the last 18 months?
Yeah, I mean, of course, Kent, everyone knows interest rates have gone up, 500 plus basis points since the Fed started raising in early 2022 as a combative measure against inflation. So that's a big, of course, factor that's the market changed the markets. And the result thus far has been a lot of things. We've seen some of this is I would say a change in demand from COVID, during COVID, after COVID, et cetera, where we are today. But
Mm-hmm.
we had a ton of, in 2020, Kent, we had a 2021, a ton of natural rent growth, natural appreciation in the markets for asset values. I mean, 15 to 30% rent growth in some markets was being obtained. And so that is not sustainable, of course. And so
Mm-hmm.
we obviously wanted to take advantage of some of those tailwinds. But today we're at, I would say, more of a flat or slight rent growth. We're still seeing rent growth in a lot of markets across the US. I think Q4 of 2022, Kent, we saw some less interesting numbers. Rents were basically going down in a lot of markets, but they've since rebounded. So 2023 is off to a pretty good start. So with that, you have less organic rent growth. You have a lot less natural appreciation. We've seen cap rates expand, gosh, anywhere from 50 to 150 basis points, depending on asset class, vintage, sector, some 200 basis point cap rate expansion, which may make it a good time to actually buy if you're getting things at 20% off where they were from early 22, like you mentioned.
Mm-hmm.
So those are some of the trends. We've seen an increase in vacancy. We've seen an increase in bad debt or tenants' inability to pay. So it's becoming a lot harder to operate a lot of these assets. So you have to know what you're doing. You have to be really good on it. You got to work harder to be able to achieve similar results, to say the least. So those are some of the changes we're seeing. Obviously, interest rates have gone up, and that's a big factor in today's marketplace. It's causing a lot of buyers and sellers to not meet, and we're seeing transactional volume. I think in recent quarter, Ken, it was like down 70% year over year. So a
Yeah.
lot less deals getting done. It's hard to understand the value of assets today because of the lack of deals, because of interest rates going up so quickly. And you just have a situation where there's a lot of people just kind of sitting and waiting and sellers not selling. And if you think about just an individual passive investor, maybe who's got a home they own, maybe they bought it a few years ago, their interest rate was 3%. Well, now it's what, 6.5%, 7%. If you want to go sell, you're going to look at that if you're going to be borrowing and wonder, should I just wait? And there's a lot of folks just sitting on the sidelines right now.
Yeah, I mean, absolutely. We're seeing that. And I think you brought up a ton of good points, right? From big movers of interest rates, which has driven a lot of different things to change. We talked about rent growth and how that's changed. What's interesting on rent growth is it's so market specific or even region specific, right? Because so we're based in the Midwest. Most of our properties are in the Midwest. And what's been interesting to me is like Indianapolis, which is my hometown, is on like its 8th or 9th month leading rent growth in the country. And it's just like that I don't think that's ever happened in history. And so it's just, and it's because we didn't have those giant increases, in the past 3 years. Right. And so we're still able to now kind of really hit our stride. And it's not 30, maybe it's 8-9% rent growth. Right. But it just really, the market really matters, and like really paying attention to what happened previously. And kind of how much there is to still grow, I feel, kind of based on how much it's grown in the past. And so with all the things, it's just one like peculiar thing that I think in this market where everything's kind of upside down is like the Midwest leading rent growth, which we just, one of those things that you would never expect to see. And we're seeing right now. And there's a lot of things like that, right? You mentioned cap rate expansion. Like I feel like prudent operators were always underwriting some cap rate expansion, but really in the back of their heads thinking, it's never really going to happen. Right. It's just, and now we're actually seeing that, we're seeing cap rates truly expand, which you said in one hand, it means you could get a good deal, right? It could be a good buying time because you're getting a good deal. You're getting something, a discount to what it was 18 months ago. On the other hand, I think what we've really seen is, you have to really be a great operator to survive in this market and to create value in an environment where cap rates are truly expanding, because that's working against you, right? So how as you guys are looking at it, I guess, as we get into how you're actually underwriting these deals, how has your underwriting or your expectations of what you're seeing and what sponsors are sending you changed related to cap rates, 18 months ago to now?
Sure. Yeah. We've kind of always underwritten exit cap rate expansion, Kent. It's just I think, a prudent underwriting strategy. That has ranged anywhere from 50 to 150 basis points on a deal, depending on the term and the business plan, of course. And so we're still essentially looking at that, but we're not expecting cap rates to expand nearly that much from where we thought they would be a few years ago to today, right? And so you should still be looking at that, of course. We're constantly looking at going in and exit cap rates.
I'm curious on your take of when we knew that cap rates continued to compress and everybody was saying, well, this isn't sustainable either, because we knew that interest rates had been held artificially low for years, right? Which is driving cap rates down. I'm curious your take now that the expansion has occurred. and we got to be close to the top of where we end up with interest rates. I don't know if we're exactly there, but we're not going to go another 500 basis points. Knock on wood.
Sure.
The has your expectation of cap rate expansion from here changed, or are you still expecting in underwriting another 50, to 150 basis point increase? Or do you think it's actually more realistic now to have less expansion in your underwriting?
I mean, there's no right answer, right? We will stress test all of our deals, Kent, and run through the models that you just literally laid out. Like, hey, if cap rates go up a quarter point, half a point, a whole point, a point and a half, at what
Yeah.
point does it no longer make sense and our returns are greatly impacted? Because it's all speculative. Nobody knows what's going to happen. We
Mhm.
think that um, there's still some cap rate expansion going to happen, right? We're at the end of July of 2023. And so for anyone listening to this in 6 months, they might come back and say, oh, yeah, that's right. It did go up more. No, he was wrong. It went
Yeah.
down, but we'll see. But we anticipate there should be some more cap rate expansion in the markets, Kent. Again, it's asset class, it's location, it's
Mhm.
vintage, all of that matters depending on how much. But we also think that a lot of it's probably already happened and been baked into these deals. And so going forward, what are we looking at? I mean, we'll run sensitivity analysis and we'll see as long as we're comfortable with the stress tests and making sure that in an uncertain situation like we're in today, if cap rates do go up another 50, 100 basis points, number one, do we have to sell at that time? What's our
Mhm.
debt? What's our term? What's our business plan? Number two, are we still happy with the end result in that maybe unlikelier situation than just a couple of years ago looking forward?
Sure. Sure. And clearly we have no crystal ball. So it's all just about how do we have prudent underwriting to prep for that. So on interest rates, you mentioned interest rates as another one. What do and interest rates are really driving debt and the types of debt that we're choosing. So how have things changed there? How
Sure.
has just the debt environment, and the ways that you're looking at debt or the types of debt you would like to have on properties, how has that changed?
Yeah, I mean, it's still evolving, but I'll say this from 2020 to 2022, the period of those 2 years or so, a lot of multifamily, for example, was financed with floating rate debt. And
Mhm.
those deals we stopped investing in early 2022. We focus specifically on fixed rate debt today for a lot of reasons, but there's pros and cons to both, Kent. Obviously, I think you know that, but there's a high exit fee if you have a fixed rate debt loan and you want to get out early. And so there's a big benefit for previous years. The floating rate debt were less expensive and you could, of course, exit the deal without a huge prepayment and defeasance penalties. And so with that, today, we're focused on fixed rate debt. Most everything is longer term, 5 to 10 year holds. We don't want to sell at the wrong time. That's how you lose money in real estate.
Mhm.
You can hold and continue to cash flow and wait out cycles. You'll most likely be fine and be rewarded for that patience. Now, it's a lot of it's deal dependent today. So I'll give you some examples. We have like what are we investing in today, and what are the interest rates and the terms? I think is usually a useful conversation for folks. But we love tax exempt apartments, Kent. They allow us to essentially the structure is we're a partner with an operating partner, and they will work with a local municipality in a public-private partnership to they allocate half the units at the property to be affordable, tied to the area median income. It's essentially a formula on the rents. And in exchange for that, you get a tax abatement. And that allows you to not have to pay property taxes for 99 years on a lot of these deals, which is a huge benefit for cash flow and reducing risk, of course. Day one, going into these deals, you see very strong cash flow. You also see a increase in purchase price versus appraised value. If the seller didn't have the tax abatement structure in place and you're buying this asset and you put it in place while in escrow, the appraised value is often much higher than the purchase price because you've eliminated your highest expense, which is property taxes. And so there's that structure there. But in essence, you're also creating affordable housing. And so that has agency-like financing. So a lot of the terms are, we're looking at a deal right now. We're in due diligence on, Kent. It's a 5.3% interest rate. I think it's 70% loan to purchase price. And you have a 10-year fixed rate debt with 10 years of interest only. And so you have a very
affordability really helps.
Yeah, absolutely. So there's products out there that still make sense for the right assets and the right investment strategy. And then further, we also are investing in triple net industrial sale leasebacks. I know it's a mouthful, but essentially you have a manufacturing business, for example, that owns their real estate, and they are getting acquired by a private equity shop, and they may not want the real estate. So they'll stay as the tenant, but sell the real estate. Our operating partners will buy it. And then you have a 20-year triple net lease in place, oftentimes secured by a private equity firm in the back end. And you have rent escalations. If each year the rents go up, it's in the lease, but you also have absolute triple net, no taxes, no insurance, no maintenance, no utilities. The tenants pay for all that.
Yeah.
So if you're looking at we've been paying attention to stagflation, Kent, where revenues are essentially flat and expenses keep going up. That's possible and probable, especially in an inflationary environment where you have decreased demand and rents and revenue are essentially not growing too much, like we talked about earlier.
Yeah.
And in a stagflationary environment, if you can get into a type of asset where the revenue is going up by contract each year and your expenses are zero, you have a very interesting situation where you can create a very attractive return and downside protection.
Yeah.
And those kinds of assets, going back to the loan, just one more point, we're seeing, I think, an important point today. If you can get a going in cap rate to be 100 basis points or more, or slightly less, 75 to 150 basis point spread above the interest rate, you're doing pretty well. And so we like to see that. And both the examples I just shared typically have a very nice spread there.
Yeah, that makes complete sense. And I mean, we're seeing the same thing as well, right? And that's why we've been focusing a lot on assumable loans where we can pick up a lower interest rate. I mean, we're working on one right now where we've got a 3.73 fixed rate for another 6 years. And the going in cap rate is going to be close to 5.5, poking towards 6%. So just creating that spread on the front end, we feel really good about. So similarly, focus on fixed debt and even more specific on loans that we can assume, trying to get into some better rate situations. Yeah. The other thing that you brought up, it seemed to be a common theme, and it matches to your stagflation comment around really focusing on expenses and then really focusing on the largest expense being taxes. And so it seems like you're really focusing on deals where you can eliminate the tax component of it. I mean, whether it's from a triple net side, where the operator owns, or it's from an affordability side on an apartment, actually taking a market rate and moving it to be partially affordable, right? And it's really about that focus on taxes.
Yeah, it's a big part of our strategy, Kent. We've been investing with this mindset for a couple of years now, to say the least. We've also been investing with a recession-resistant mindset since 2018. We created a recession-resistant fund. At the time, we thought there was some signals in the market that there was going to be a correction. There wasn't, but nonetheless, it's trying to time the market is not something that we are trying to do, but we are reading all the signals and trying to understand the best way to position and how to invest wisely to still get a great return while reducing risk. And so if you can eliminate property taxes, one of your biggest line item expenses, great. Let's try that, see how that works. And so We've been doing that for a little while with operating partners that focus specifically just in that space, right? So
Hmm.
we partner with pros that know a lot about how to do this. They have a track record, and of course, are very successful at just one thing. That's how we like to diversify.
Yeah, absolutely. Absolutely. No, I think that was really insightful. And then, so as you're looking at your underwriting, so we talked cap rates, we talked interest, anything else that sticks out right now, as you look at changes from, again, in the last 18 months to how you were underwriting to how you are now, anything else that's really changed?
I think one of the things we continue to pay a lot of attention to is if like, let's say you're a passive investor, you're looking at a projected deal return. You want to see some income, some growth, right? We're going to get X cash on cash in year one, year two, year three. We'll sell it in year five. You want to look at what's the percent of your total return that's coming from the distributions, the cash flow
Hmm.
versus the sale proceeds. And that is a big one for us today because think about it this way. If you have a heavy value add asset that's not producing much income or cash flow for the first 2 years, but you're planning to, of course, grow the value and sell it in, let's say, 3 to 5 years, you're probably going to see your total return is very heavily weighted on that sale, right? And I'm kind of exaggerating a little bit with a very simple example here just to get the point across, but you might see 80,
That,
90% of the
yeah,
total
that's almost like a
return.
ground up type
Right. Yeah.
scenario, right? You
Yeah.
expect no cash for a couple of years and then be able to get in and sell, right?
Exactly. And in that case, you probably get what 90% of your total returns coming from the sale.
Yeah.
Then you have assets in the middle where maybe it's a stabilized multifamily property where you're going to get a little bit of cash flow, 3%, 4%, 5% in the first few years. But there's also a value add play where you're going to renovate the units and maybe there's loss to lease and you can capture that and grow the revenue more manually
Yeah.
versus forced depreciation versus organically. Even in that case, you might still see, 70% of your total return coming from the sale. And
Hmm.
so that comes with execution risk. You have a situation where you're relying on the operating partner to go out and do these 5, 10 things over and over and grow the value. And so there's more risk there.
What are you
Versus,
guys looking
yeah,
for? So when you're looking at deals, like, and everybody has their box, so like if it's got to fit in this
sure.
box, right? So what are you looking for? Is there a ratio that of, you know, of return that's coming from cash versus coming from appreciation? Is there a ratio that's a sweet spot for you guys?
Yeah, so I'll say this. So we invest in direct deals. We'll invest in 123 Main Street
Yeah.
and that property and that by itself. We also create funds where we'll combine multiple assets together, multiple investments together,
Hmm.
and spread our capital, spread our risk, diversify. And in that model, we try and create, of course, it's hard with deal flow being tight, but you want to try and create a balance where you have some investments that are on the much lower end scale of growth, maybe 70% of the returns coming from the cash flow and the actual distributions, and only 30% from the appreciation. And then you can combine it with the opposite, right, where you have another investment that has a lot more growth and a lot less income. And if you can do that, then you have a nice balance where you're going to get income and growth, and you're reducing your risk because each one has risk. And then when you combine the two of them, you of course are spreading that risk out. So
Sure.
we like, excuse me, we like kind of, I would say the full gambit, but we today aren't investing directly into high growth investments. That's just not it's outside of our risk tolerance levels, Kent. If we see something that we think is very attractive from that standpoint of a business plan where we're going to focus on growth, we'll usually put a small allocation into a fund, which has a lot more income and cash flow. So I hope that helps answer, but there isn't necessarily like, oh, we only do 50-50. We
Hmm.
look at all and we try and compare and contrast and really combine when there is a compelling opportunity to do so.
Sure. Sure. Yeah, that makes complete sense. And you're putting it into a fund to diversify. I mean, it sounded like if I was pulling something out of that, I would say, if you're kind of 70-30, it might be a decent mix of cash to appreciation. And as you kind of get above that, you have to start really thinking about what's that risk reward and how likely does that appreciation occur. I mean, my sense would be that deals have probably started to shift the other way just because we've talked about cap rate expansion. It's harder to get that appreciation if you're really truly expanding the cap rate. But I guess deals have also been hampered in current cash because of interest rates. So I
That's
don't know
right.
across a large sample size how that pendulum has swung. But
It's tough. That's the market today. You just nailed it. Like
yeah,
you can't very easily find exactly what you're looking for when it comes to income and growth, for the
yeah,
reasons you mentioned. So there's
yeah,
still deals out there. You just got to look harder. You got to understand how these returns are being projected. I mean, there's some operators out there, Kent, that will, they'll buy the stabilized apartment and they will overraise on their capital and they'll return some of that capital to investors in year one.
yeah,
They call it cash flow, but it's a return of capital, not a return on capital.
right.
And so they're kind of stepping on their own foot in order to be competitive in the marketplace and to show good returns. So we watch out for that stuff. We're looking
Yeah.
for deals that pencil and that provide strong cash flow without having to return equity to folks and call it cash flow.
100%. Yeah, 100% agree. And yeah, the deals need to produce on their own. I think that makes a ton of sense. And okay, well, I think those are some really good insights. I mean, just how you guys are looking at things when we've hit on really, it's the type of debt really matters, the focus on fixed, right? And how you're protecting your interest rate risk. And we talked about, we're still expanding cap rates, which we've always been doing in prudent underwriting. So it's just more that we're not able to hit a home run because we underwrote expansion and they actually cap rates compressed, right? We're actually seeing
Yeah.
what's happening from our underwriting actually play out. That's not necessarily a bad thing, as long as you're underwriting prudently the past couple of years, right?
Right.
And then we talked a lot about this idea about stagflation, really that idea where the revenue increases are harder to come by, expenses continue to grow, and how does a deal look in that environment? And so I think my takeaway there would be in underwriting, the things to be looking for, what are the rent growth expectations and are they realistic, or are they tethered to kind of the anomalies we've seen over the past couple of years, right? Are people going back to more historic averages is how I would look at that from a long-term perspective as they project forward. So I think really good nuggets, Mark, that you brought today. I think a lot of for our listeners to think about as they analyze deals right now in today's market. And as you said, July 2023, because I know by October 2023, things are going to look a lot different again. So we'll timestamp it, but appreciate you bringing some really deep insights on how you guys are looking at deals and giving our investors some perspective there. Before I let you go, I want to take you through our keys to success round. We've got 4 questions I'm going to ask you. The first one is, and this is right up your alley, right? Because it's literally what you do. If you're going to invest your capital into somebody else's deal, but you could only ask them one question, like that's it. You don't know anything else.
Nothing, huh?
What's the one question you would ask them?
Oh man, that's a tough one, Kent, as you know. I would ask them, how are they being conservative in their projections? And what are you trying to get out of that, right? Like, what's the purpose of that question?
Yeah.
So for me, it's I want to listen to, oh, well, we didn't include this and we didn't include that, and we don't have any other income assumptions, and we're assuming rents are flat for 7 years, when in reality the local market's going up by 3%, and et cetera, et cetera, et cetera, right? Show me how conservative you've been by just kind of softening and sandbagging the projections and the returns. That to me is a really important question to ask, in addition to so many others. But I would start with there.
Gotcha. Yeah. I mean, I like that question. I think it's, in my perspective, there's always got to be some quote unquote sandbagging, right? You've always got to have extra cash in the deal, rainy day funds, reserves, right? That's one way to sandbag. Um, and then, yeah, you're essentially testing all of their assumptions, right? And then you're looking to what's that assumption based off of, and is that accurate, right? And I think that's the trap. Like, it gets the trap of a lot of people, of this bias, this recency bias to what's happened the past couple of years, right?
Mhm.
And the understanding of that really being an anomaly and most likely not going to continue to happen into the future. So really testing all those assumptions. So I like that answer. Next question is, what are you most proud of in your career?
Most proud of, I'd say, we've pivoted, as I mentioned earlier in our talk, Kent, a couple times, like leaving corporate America and then no longer being an operating partner or sponsor. And those pivots are hard to do. Let's be honest. It's difficult to change course. And so I'm proud of doing that. I think looking back, I wouldn't change a thing. Um, and with that, I think, the result that we're quite proud of is, if we look at our investor base, Kent, those that trust us with their capital, today we've got about 60% of our investors are repeat investors. They've got more than one active investment with us. And I think it's over 20% today have 5 or more active investments with us. So just be proud of that, right? These are folks that are trusting you. They rely on us for diversification, bringing them high quality investments year over year.
Well, yeah, absolutely, Mark. There's a ton to be proud of. And it's, yeah, I think those metrics on your investor base just show the quality of deals that you guys are bringing through and the returns you've been able to provide. So congratulations on that. Next question is, what book should everybody read?
Yeah, I think one that I would recommend to most if they haven't read it is 12 Pillars by Jim Rohn. Have you heard of it?
I have. Yeah.
Yeah. Okay. It's I mean, you probably know it then, but it's a fast, easy read that you probably want to read once a year, just to remind yourself of some of the best strategies to be great in life and in your career.
Yeah, I like that. Yeah, great recommendation. Lastly, Mark, what is your number one key to success?
I would say drive, just constantly having this never-ending thirst for more knowledge and understanding and learning, and drive. Yeah, that's it. I where I got that from and how, who knows, but I'll probably thank my parents at this point in this conversation. But yeah, that's been it. You go through a lot of tough times. You have to get back up. You have to keep going. You have to hopefully love what you do, which will help you get back up and keep going, and having that internal drive. And if you do, then if you're in a tough spot, keep your head up. Just keep going, because that drive is what's going to get you to success.
Absolutely. That's a great answer. That drive, wherever it comes from. There's so many themes on this show of just that drive, that consistency, that showing up every day. I mean, time and time again, the successful people we have on this show, the answer comes down to one of those concepts. So,
Mhm.
I mean, absolutely, I think critical to success. So, thank you for sharing your keys to success. Before I let you go, Mark, I'm sure there's people listening that want to know more about SMK and about what you guys are doing. So, how can folks reach you?
Yeah, our company name is SMK Capital Management. Our our website is smkcap.com. We have a lot of information on current investments, recent investments, some of our thesis behind why we do what we do. And then people can sign up to join our investor group there, Kent. And then also you can email me at info@smkcap.com.
Great. Well, we'll list all that below, multiple ways to get a hold of Mark and his team and learn more. And Mark Khuri, thank you so much for coming on today and sharing your knowledge with the group. And we hope you have a great rest of the day.
Thank you, Kent.
Thanks for listening to another great episode of Ritter on Real Estate. Hit the subscribe button to make sure you don't miss out on the content that will make you a better investor. Also, visit kentritter.com for articles, videos, and tools curated just for passive investors. Until next time, this is Kent Ritter with Ritter on Real Estate. Now go out and invest like a pro.